One of my stocks went up 13% yesterday after they reported earnings. Hello everyone, welcome back to your channel. Today we're going to talk about a stock that I've been investing in since last year, and they reported earnings yesterday and the stock went up massively. We're going to analyze their earnings, their stock performance, and their expectations, and also an update on my position. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. And as you can see, that stock is Lyft, ticker symbol LYFT. The stock went up 16% after hours, as you can see here, but still it is down 20%. Remember that this 20% is without this 16% that was after hours, but still it was down 20% in the past 6 months, but still it's up 72.78% in the past year. Now we can see that the stock is trading at $52.56 per share as it is up after hours or pre-market hours at this time, as right now it is 6:41 a.m. and it has a market cap of $15.4 billion. We can see here that it has a forward PE of 94.34, but a price to sales ratio of 6, which if we compare with Uber is an $83 billion company, but it also has a price to sales ratio of about 6.37. Now we can see that the stock also went up 6% after hours, and I would assume it is because of Lyft earnings. But if we compare their performance in the past year or year to date, we can see that both are down a lot, but Lyft is down 7% and Uber is down 13%. Then if we compare in a yearly basis, Lyft is up 84% and Uber 27%. But this is because before Uber was up more than Lyft. As we can see, in the past 2 years Uber is winning, and in the past 5 years or maximum as they went public in 2019, both are down in the past 5 years, but Lyft is down 42% and Uber 30%. Now we can see here that certainly the growth that Lyft has been having was amazing since 2018 until 2020, as we saw a huge drop because of everything that happened, and it has been recovering since then. This is quarter 2, still not quarter 3, but quarter 3 was over this one. We can see that Lyft says drivers are coming back. Shares jumped 12% because we know that Lyft, or actually every industry, was struggling with workers, as there was a shortage in workers during the pandemic and after the pandemic because of all the stimulus and all that, and they're finally seeing drivers coming back. But the thing is that they have been spending a lot of money in drivers incentives, but still they reported an earnings per share of 5 cents, while at 5 cents adjusted, while analysts were expecting a loss of 3 cents. So they reported a profit while analysts were expected a loss. Now they reported a revenue of 864 million, beating analysts' expectations, just as our revenue per rider as well as $45.63 versus 43 expected by analysts. Now active riders they missed active riders, as they had 18.9 million versus 19.7 million. But this have kind of an explanation as well. They were having a shortage in drivers, so that means that customers would have a longer wait time and maybe more expensive rides. So we might think that riders were actually using other platforms or maybe just their own vehicle. But now that they're seeing their drivers coming back, they might see this go up in the coming month. As I said, the company has struggled with driver supply and demand imbalances throughout the pandemic, leading to higher costs or long wait times. Investors have been attuned to the imbalance, especially as the company has invested millions in incentives to bring drivers back to the platform. Now, let's check their earnings. We can see that certainly they reported this quarter $864 million, which is up 73% year over year, but obviously it's not at pre-pandemic levels. As we can see here, I wrote here that in quarter 3 of 2019 they reported a revenue of $955 million in comparison to $864 this last quarter. What I like the most about this is that even though they are not in pre-pandemic levels, their net loss is way lower than it was in pre-pandemic levels. So I wanted to check that later. Now we can see that the revenue per active rider was an all-time high revenue per active rider of $45.63, and active riders is at 18.9 million riders. We can see that obviously in Q1 2020 was really high, pre-pandemic levels, but it has been recovering very nicely during and after the pandemic. Same with the achieved record contribution margin. It was a record of 59.4%. As you can see, all the way from 2016, it's a complete record in this last quarter. So yes, certainly they are not in pre-pandemic levels, but they have been able to be more efficient and perform better in their margins as well. Now, they had a great quarter. Driver supply materially improved in Q3, up nearly 45% versus last year. We can see that their active riders is up 51.4% in the past quarter, year over year. Still, they missed analyst expectations, but the revenue per active rider was up 14.2%. So we can see that they have been having a nice riders growth since the second quarter of 97% and the third quarter of 51%. Now, this is what I wanted to talk about. We know that they had a revenue growth of 73%, and their cost of revenue only grew 39%. But I have to talk about that after this. We can see that total costs and expenses only grew 9.2%. But we do have to take into consideration that last quarter they reported a revenue of 499 million and had total costs and expenses of 953 million dollars. Because of the pandemic, they were spending a lot of money in drivers' incentive, in riders, and all of other expenses that they needed, plus stock-based compensation because of the pandemic. So obviously the gross margin was not that good as it is right now. So that is why we see the total costs and expenses only grew 9.2% while revenue grew 73%. But in my opinion, this is excellent because it means that even though the revenue grew that much year over year, they have been able to work or manage the company very well in order to have a net loss of $71.5 million, which is what I wanted to talk here. We can see that they had a $71.5 million in net loss, but since Q1 2020, we can see that their net loss have been decreasing massively quarter over quarter and year over year until 71.5 million, which is very, very impressive. We do have to take into consideration that they have a high stock-based compensation of $198 million, as we can see here, which obviously without that, they would be profitable. And that is that 5 cents profit that they reported that beat analyst expectations, but we're gonna see that later. As I said, we can see that they have a high stock-based compensation. In the past 9 months, it was $563.6 million in comparison to over $430 million in 2020. Still, this is what I was talking about. Their adjusted net income, so they reported a net loss of $71.5 million, all the way up, or a huge improvement from $459 million in the past year. And we can see that without amortization of intangible assets, without stock-based compensation of $192 million, payroll tax expenses, and costs related to acquisition, we can see that they actually had an adjusted net income of $17.8 million, meaning that analysts were expecting a loss and they were able to report a net income here, an adjusted net income, which is what made the stock go up that much. Now, I have a position in this company. As I said, I've been investing since last year. Before and after the pandemic, as you can see here, I'm up 88.80% in my position at the moment, with an average cost of 27.95%, and it only represents 3.79% of my position, because when I started investing, it was before the pandemic, so I was losing money in March. So when I started investing was back in February 2020, when the stock was around $45 per share. I'm gonna put a screenshot here, and the stock started dropping after because of the pandemic, and we can see that I bought again at $20 per share in March, and at 25% at $20 per share in October. So because of that, we can see I continued buying until the end of October 2020, and because of that, I have a nice average price here, average cost at the moment here. But the stock was certainly down during the pandemic, as I started investing right before shutdown started. So because of that, I was able to have this kind of good return, because I invested during the crash that it happened in March until October. Now I'm gonna leave you here my top 10 performers on my stock portfolio if you wanna go and watch it after this video. Thank you and see you next time.